Great, and welcome to today's session. This is financial reporting. And I want us to look at the income tax concept, International Financial Reporting Standard 12. And as we know, when we talk about income tax, we have two types of taxes. That is the deferred tax and also the current tax, deferred tax and the current tax. And among the two, one is a non-current asset and the other one is a current asset. Now, maybe to ask, between the deferred tax and the current tax, which one is a non-current asset? Which one is a current, not asset, but liability? Non-current liability and current tax liability. Current liability and non-current liability. So, as we talk about current tax, that is a current liability. Current liability is a current tax, yes. And then a deferred tax, it falls under non-current what? Non-current liability. Good. So, we shall start with the current tax. Current tax. It's actual amount of tax payable. It refers to actual amount of tax payable. Actual amount of tax payable by the company in relation to a certain accounting period. By the company in relation to a certain accounting period. So when you're preparing your income statement, we have the profit before tax, then less tax. That tax is what we refer to as current tax. That tax is what we refer to as current tax or corporation tax. So you need to note that. So when you talk about accounting period, this is the financial year. One financial year. So it's a short term, go within a period of 1 year or 12 months. So this tax is paid according to or based with the company what? Taxable profit. It is paid based on the company taxable profit. It is paid based on the company taxable profit. So it is paid based on the company taxable profit. We have two types of profit. So it is good we differentiate types of profit. Two corner. One, accounting profit. One is accounting profit. And the other one is taxable profit. So it is good that we do taxable profit. So we have two types of profit cards. One is taxable accounting profit, and then we have a taxable profit. So this current tax is paid based on the taxable profit. It's paid based on a taxable profit. So what is accounting profit? Of course, for us to get accounting profit, for accountants to get accounting profit, they use various standards. They use various standards. So for this one, you use various standard to arrive to it. And this one, taxable profit, it is computed based on the existing tax rules. Computed based on existing tax rules. You know, you have to follow some tax rules. So this is computed by an accountant, and we use the accounting standard. We use the accounting standard to arrive to this accounting profit. So to arrive to accounting profit class, we use the accountant use the accounting standard, the GAAP, General Accepted Accounting Standard. And the other one, we need to look at the existing tax rule. What does the rule state? So for instance, if we talk about a taxable profit, is somewhere you less the allowable what? Allowable expenses. We less allowable expenses to arrive to taxable profit. Allowable expenses, you know, there are those expenses that we less allowable expenses to arrive to that expenses. There's the allowable expenses to arrive to the taxable profit. This is a PFT concept, Class, how do we compute the current tax? Current tax computation. Current tax computation is very simple, very, very simple. Current tax computation. Current tax computation. To get the current tax, just need the taxable profit times tax rate. So current tax is equal to taxable profit times tax rate. So at this point, your taxable profit can be maybe profit before tax, no? Profit before tax. So profit before tax is, tax rate is 30%, yes. So 30% of the taxable, the profit before tax. Then remember, the prudence concept is applied here, whereby we say that we create a provision. For example, if you have the profit before tax, less tax, like that. That's what do we get? What is the result? Profit before tax, less tax. And that tax is given as a provision. In most cases, a provision. It's provided for, right? Provision. So we get profit after tax. That's very true. We get profit after tax. This tax here is just a provision. I want you to note. It's just a provision. And that's why in most cases, you'll find traces of tax under the current what? Liability. You'll find traces of tax under the current liability, indicating that for sure this was not the actual tax paid. It is not the actual tax paid. You'll find some traces there under the what? Under the current liability. Telling you that this is just a provision. The tax which is there is just a provision. The same way we provide for depreciation, you know, provision for depreciation. Still, that depreciation may not be the actual one. You know, you need to adjust several items. So it's just an estimate. So if you win it, you can determine the actual amount of tax paid, and through that you'll be able to proceed with the what. So you have to consider the previous year tax and also this year tax. And that can give rise to either under provision or over provision of tax. It can give rise to either under provision or over provision. Under provision or over provision. Under provision or over provision. I want us to have a scenario that will help us understand this provision and know how we can treat it and how we identify it. As far as the trial balance is concerned, how do we identify whether we have an under provision or over provision? So I want you to have this. You say that the provision created, if the provision created is more than the actual tax to be paid, the provision created, if the provision created is more than the actual tax to be paid, the provision, if the provision, maybe you provided for tax, which is more than actual, if we get maybe 30% of the profit before depreciation or before tax, you get that one could have given us lower amount, right? So for instance, assume hapa tuweke 2 million as a tax, 2 million as tax. So if this 2 million itakuwa more, it will be more than the 30% of this. 30% of this. This is what we say that if the provision created is more than the actual tax to be paid, in such financial year, there was a provision of current tax. There was a provision. Of course, that one, we call it an under provision, under provision. So under provision of current tax, under provision, under provision of current tax, under provision of current tax. So provision is less than actual tax. I think that that statement you have to rectify that. Rectify provision. Under provision is when the tax is less than the actual. Whatever that we have provided is less than the actual. Under provision of current tax, the provision is less than the actual tax. Provision is less than. So can they correct this? Provision is less than. It's less than the actual tax. The actual tax. Provision is less than the actual tax. So provision is less than the actual tax. So under provision of current tax, you find that the provision is less than the actual tax. So if, for instance, we provided for 2 million and the actual is 3 million. Actual is 3 million. 3 million. Maybe this is 2022. 2022. In the year 2022, we provided for tax being 2 million and the actual tax would be 3 million. So that becomes an under provision of current tax. It becomes an under provision of current tax. And under provision of current tax. Under provision of current tax. Under provision of current tax. So where do you think that appear, the other provision appear in our trial balance? Where does it appear in our trial balance? Under provision, under provision, under provision. Where does it appear? On the debit or credit side? Under provision. Debit, yeah, it appear on the debit side, under provision. So ukiona traces za tax zimewekwa side ya debit, zimewekwa side ya debit, right, under provision, it was under provided. it was underprovided. It was underprovided. Ukiziona on the other side, so vice versa is true. Vice versa of what you're talking about is true. Vice versa is true. So it is debited. So it has a debit, a balance in the trial balance appear on the debit side. Appear. So you can write this. Under provision of current tax has a debit side or appear on the debit side of the trial balance. Under provision of a current tax appear on the debit side of the trial balance. To appear on the debit side of the trial balance. On the debit side of the trial balance. And by the way, there is an NB here, an NB here, an NB. Let's have in relation to maybe this 2022, in relation to year 2022. Let's assume that 2 million, then 3 million is the actual. So that means there's other provision in that case. So NB, and a provision is carried forward, and a provision is carried forward to the following financial year. And a provision is carried forward to the following financial year. That is an NB. And a provision is carried forward. To the following financial year. E.g., if it is for 2022, kama hii tumesema hapo, if it is for 2022, it will be carried to 2023 and added to estimated tax liability. If it is for 2022, that other provision, it will be carried to 2023, right? That financial year, and added to estimated tax liability. Now, you know, in 2023, we are going also to estimate, right? In 2023, we are going to estimate, right? So 2022, we had estimated, we had a provision, which is 2 million, right? And the actual is this. So it gives rise to another provision of, is it a million? There is a 1 million pending somewhere, so that 1 million can be taken now to 2023. So provision for 2023, we add 1 million, you know, we add 1 million. So that's key. Immediately you find your provision on the debit side, note that you're going to add it. It will increase the tax for the next year, next financial year. So we will be able to see it when we shall be doing an illustration, be able to see that. Then over provision, you can have the next one. This is under. Let's go to over provision. Of course, it's vice versa. Over provision. When the provision is greater than the actual tax, when the provision, so this is over provision. By the way, class, where should we expect this in our trial balance? Over provision of current tax. Where should we expect of current tax? Examiner can ask you the treatment of this. I expect which side? On the credit side, it's vice versa. It is the other way around. So vice versa. So when the provision is greater, when provision is greater than the current greater than the actual tax, The impact of this vice versa. So it is carried forward to the next financial year. When we carry this, the over provision to the next financial year, does it reduce from the balances of the estimated tax liability, or does it increase that? We add or do we less? So this one is carried forward. It is carried forward to the next financial year. Like that. Asante. So that it is going to reduce. It has a credit balance in the trial balance. It it has a credit balance in the trial balance. It has a credit balance in the trial balance. Correct, credit balance. It is deducted in the estimated tax liability. So unafaa tu kushika hivyo. Am I dealing with the under or over provision? If it is under provision, the under provision will be added to the next financial year. The over provision will be subtracted to the next financial year, of course, under the estimated tax liability. So tumesema kwamba it is deducted in the estimated tax liability. In the estimated tax liability. So if the provision is more, than the actual tax, remember that it is going to reduce. It is going to reduce the next year what? The next year tax. So for instance, if 2022 we had 5 million, and the actual was 3 million, So that means there is an over provision of how much? Means it's an income to you. Yeah, Kiprangat is now translating it to be an income. Yeah, okay. Usually, so you an account there. Yes. And hapo sasa ndio mambo inaingiaga. If you prepare your tax account here, tax account. Alafu, of course, this one we know it has a credit balance. So the balance brought it down. Sawa, naweka pale. Balance carried down takuwa hapa. Now, if the balancing figure is on the credit side, we say that this is a tax expense. This is a tax income. Yeah. Okay. So there's a way. Yeah. With tax expense, tax income. So tax income reduces what? Tax income reduces the expected. What tunasema it offset. Sasa KRA pia wanawakili na concept kama hii, ukilipa more than you expected, ukilipa tax mingi, so that means hawatakurudishia, but now the next year tax they are going to offset from the this year balance. You get that? You understand? Are we together, class? Are we together? I want to give the next statement here. Good. Now, over provision tumesema kwamba kama 2022 the estimated is maybe 5 million and actual is 3 million. So there is a provision, there is an over provision of how much? 5 minus 2. 5 minus 3, it will give me 2. And if in 2020, if I work with the same 2022 and 2023 tax, this is estimated, we usually call it estimated tax liability, 2022, estimated tax liability, assume it's 6 million. Now, what are we going to record? When we are preparing that statement? That was 6 minus 2, right? Yes, now 4. Thank you. So over and under provision. That's very important. Let's look at deferred tax now. That's the current tax. Let's look at deferred tax. Deferred tax. Number 2, deferred tax. Defer. When you talk about deferring, it is you can postpone. Or delayed tax. You know, you can delay. We were expected to pay this tax in the financial year 2025, but we did not manage to pay. We pay it in 2026, maybe December, if our financial year is ending in December. That is what we call deferred, something delayed. You can defer your education as well. Maybe if with 1 semester, 2 semester, deferred. You delay. You did not do it in the expected period. And that's why it will become an uncurrent liability. It's a long-term now. A long-term liability to the company. So arises due to the difference between taxable and accounting profit. Arises due to differences between taxable and accounting profit. Between taxable and accounting profit. Arises due to differences between taxable and accounting profit. Deferred tax asset is a refund. Deferred tax asset is a refund. Is a refund. Deferred tax liability, of course, hiyo itakuwa liability. So tuko na deferred tax asset na deferred tax liability payable. So deferred tax liability is payable. Deferred tax liability, as the name suggests, this is payable. Is payable. Vile tu tumesema how KRA work. People want tax, they will refund, but they don't necessarily refund. Kwa sababu si bora si next year hiyo mwaka ingine utakuwa na deni yao. They offset. So a refund is indicated as a refund in the portal. So that is it. This can be refundable to the company. This can be paid now to the government. So with that, I think we can have a simple illustration, just a simple one. Let's try to have this illustration kidogo hapa. If we have the profit before tax, this is accounting profit. Tumesema it's given it arises due to differences between the two, the taxable and the accounting profit. So accounting profit iko hapa, and that is 6 million. Accounting profit class is 6 million, and taxable profit is equal to 4 million. You know, accounting profit. So tulikuwa tumeestimate, if we refer to what we had here, we had estimated 6 million, right? But now tutalipa nini? Yani itakuwa taxable ni 4 million. You get taxable will be 4 million. And the tax rate in most cases inakuwa 30%. So actual tax to be paid, this taxable profit. Actual tax will be paid class. Tutakuwa na ngapi? Actual tax. So to be paid. Actual tax to be paid class itakuwa ngapi? Based on the taxable profit, 4 million. Sindio? So itakuwa 30% of 4 million. 30% of 4 million. That will be the actual tax to be paid. Itakuwa ngapi? How much is that? How much is that? Now, based on the what? Based on the taxable profit. Based on the taxable profit. 1.2 million. 1.2 million. That is based on the taxable profit. Based on the taxable profit. It's just a simple concept, only that it needs you to just look this thing in a wider way. So I hope hadi hapa tuko pamoja. I've just referred to what we had. Naenda tu na ile 6 yetu, 6 million, and now 4 after deducting the over provision of 2 million. You get? So naenda tu na hiyo 6. Now after that, what about now the actual tax to be paid, the tax that was to be paid if I consider the accounting profit? If I consider accounting profit. Consider accounting profit. Itakuwa 6% of 6 million times 30% or 30% of that. So according to accounting profit, tax yenye ingelipwa ni ngapi? What is that in brackets? So Vincent, bracket. Accounting profit, Vincent. Accounting profit hapa na huku tuko na based on the taxable profit. Sawa. You need to be very keen. Accounting profit based on the taxable profit. So these people are giving me 1.8 million. You see, as far as the accounting profit is concerned, these people would have paid 1.8 million. Now, what have you said? Or maybe before even I open this to you, please give me the deferred tax. Give me the deferred tax. How do we get the deferred tax? It is the difference, it arises due to the difference between the taxable and accounting profit. Yeah, taxable and accounting profit. Yes. Yeah, 0.6 million or 600,000. That's very correct. Yeah, the difference between the accounting profit and the taxable profit give rise to deferred tax. So deferred tax will be 1.8 minus 1.6, which is 0.6 million. 1.2, sorry, this is 1.2. So 1.2. You get 0.6 million. So this 0.6 was supposed to be paid, but has been postponed to be paid in the future. So but it has been postponed to be paid in the future. It will be paid in the future. So that is very good. NB, the difference between accounting profit and taxable profit can be classified into 2 categories. The difference between accounting profit and taxable profit can be classified into 2 categories. And these categories are permanent difference, and timing difference. So your difference is classified into 2. Classified into 2: permanent difference na timing difference. Permanent difference na timing difference. Sometimes the examiner will ask you to differentiate between the permanent difference and timing difference. Permanent difference and timing difference, and give you 3 marks. Permanent difference and timing difference na kupatia marks ngapi? 3. Kupatia marks 3. So let's define permanent difference. Start with the first one. Permanent difference. You say that it is the difference between accounting profit and taxable profit. Vincent, why should we repeat? We are just here. We have permanent difference and timing difference. Sasa tuna define permanent difference. Vincent. Huyu ni yule Vincent Wesonga. Hiyo statement ya kwanza Vincent, you're going to get it. You're going to get it. Tunasema kwamba permanent difference. We are defining permanent difference. It is the difference between accounting profit and taxable profit. It is the difference between accounting profit and taxable profit. Accounting profit and taxable profit, which occur due to items which occurs due to items of income and expenses which occur due to item of income and expenses which were taken into account while computing accounting profit. While computing accounting profit. While computing accounting what? Profit. And we're not taken into account while computing taxable profit. While computing taxable profit. You know, when we are computing taxable profit, there are those items which are allowable and there are those which are disallowable. You know, allowable and disallowable. So this concept may give rise to a permanent what? A permanent difference. That will give rise to a permanent difference. A permanent difference. So tumesema Abdara, the difference between accounting profit and taxable profit can be classified into two. And these are the classification, right? Those are the classification. A permanent difference and a timing difference. The difference between accounting profit and taxable profit can be classified into two. That is a permanent difference and timing difference. I hope tuko pamoja. Sasa, at this point, where we have the permanent difference, we say that it only occur once. The difference will only occur once. You can write that down there. The difference will only occur once. The difference will only occur mara moja. And the difference do not give rise to deferred tax. Sasa hapo, the difference do not give rise to the difference. So kulingana na hizi item tumeongelea hapa. The difference do not give rise to deferred tax. Difference do not give rise to deferred tax. Let's look at a timing difference. Timing difference. Let's look at the timing difference. So for a timing difference, this is what we say. The timing difference happened to timing difference. You see that it arises as a result of taking certain items. It arises as a result of taking certain item certain items of income and expenses certain items of income and expenses in calculating accounting profit and taxable profit. In calculating accounting profit and taxable profit. Taxable accounting profit and taxable profit in different accounting period. In different accounting in different accounting period. In different accounting period. So at this point, expense will be treated as allowable expenses. Expense will be treated as allowable expenses. Okay. Expense will be treated as allowable expenses. The difference reverse in year to year. The difference reverse in year to year. The difference reverse in year to year. The difference will reverse in year to year. The difference reverse. So e.g., using the expense in computation of accounting profit, using the expense in computation of accounting profit, and in the next year, use it to compute the taxable profit. Use it to compute the taxable profit. You know, timing difference. Class, do you think this will give rise to deferred tax? Automatically, this one give rise to taxable or deferred tax. It will give rise to deferred tax. So this one gives rise to deferred tax. Yes, timing difference will always give rise to deferred tax due to that differences in accounting period. So we have several terms that I want us to define, definitions of terms. So wakati mwingine examiner atalikuwa you define them. Definition of terms. Number one, carrying amount. So carrying amount, this is a term that we have been able to interact with. CA. So class, carrying amount is the same as jina ingine ya carrying amount. Tumeinteract na hii. Fair value, net book value. All right. Net book value. All right, great. You say that the value at which, just say this, the value at which the asset and liability is recorded. The value at which the asset and liability is recorded in the statement of financial position. Soft. The value at which the asset and liability is recorded in the statement of financial position. That's what we call the carrying amount or the net book value. Sometimes we can call it the original value. So, or the book value of asset and liability. Tumemalizana na hiyo. Twende kwa tax base. Let's define tax base. Number 2, tax base. TB. Tax base. Let's define tax base. Say that value of asset or liability for tax purposes. Value of asset and liability for tax purposes. Value of asset or liability for tax purposes. Value of assets or liability for tax purposes. And it is good to mention that when it comes to PFT, I know usually say written down value when it comes to net book value, written down value. So those are some of the terms used there under taxation. Written down value. Temporary difference. Ya tatu, temporary difference. Unaona the difference between the carrying amount and the tax base. It gives rise to this temporary difference. So kichukua carrying amount to a tax base, unapata temporary what? A difference. So temporary difference, useme the difference between the tax base and the carrying amount. It is the difference between the tax base and the carrying amount. The difference between the tax base and the carrying amount. Then you say that temporary difference can either be temporary difference or difference can either be temporary difference can either be 1, taxable temporary difference. Roman 1, taxable temporary difference. So inaweza kuwa hii inaweza kuwa taxable temporary difference. TTD, taxable temporary difference, TTD. Very important. Hii itatusaidia ku alive even to getting our deferred tax vizuri. Taxable temporary difference. It is a temporal difference. It is a temporary difference or temporal difference which give rise to deferred tax liability. It is a temporary difference which give rise to deferred tax liability. Very important. It is a temporary difference which give rise to deferred tax liability. Hiyo muhimu. When you talk about taxable temporary difference, remember that will give rise to deferred tax liability. What about deductible? Number 2. Deductible temporal difference. Deductible temporal difference. Deductible temporal difference. Deductible temporal difference. DTD. Deductible temporal difference. You see that? It is a tax difference. It is a tax difference that give rise to deferred tax asset. No. Hii imetupatia give rise to deferred tax liability. Hii imetupatia deferred tax liability. This one will give rise to deferred tax asset. So difference in hapo. So when you're dealing with a deductible temporary difference, it will give you a deferred tax asset. And asset, ni kwa kampuni, hii ni kama it is value to the company, right? These are liability to the company. Liability to the company. Taxable temporary difference give rise to that. Good. And then we have deferred tax liability. Deferred tax liability. Tax recoverable. Deferred tax liability. Deferred tax liability. Let's look at deferred tax liability. Tatu. Deferred tax liability. Sasa hii. Deferred tax liability. Deferred tax liability. Deferred tax. It is the amount of tax payable in the future. It is the amount of tax payable in the future due to taxable temporary difference. It is the amount of tax payable in the future due to taxable temporary difference. Andika hiyo TTD. It is the amount of tax payable in the future due to taxable temporary difference. Due to taxable temporary difference. That's very important. So, what is giving rise to deferred tax liability? It is taxable temporary difference. Sasa hapa ndio nataka tu tushike so that wakati unapatana na swali it will become easy to interpret. Taxable temporary difference give rise to deferred tax liability. Give rise to deferred tax liability. So how do we get deferred tax? How do we get now formula deferred tax hapo? Deferred tax be given by taxable temporal difference times tax rate. Tax rate. Hii formula yenye unafaa kushika vizuri. Deferred tax will be given by taxable temporal difference times the tax rate. Times the tax rate. Times the tax rate. Taxable temporal difference times the tax rate. So how do you understand? How do you know whether it is a taxable temporary difference? Hapa ndio tunaenda. How do you understand or how do you know that it is you're dealing with a taxable temporary difference? Let's see. If you've been given the carrying amount, if you've been given the carrying amount, all right, and the tax base, carrying amount, net book value, and the tax base, carrying amount and the tax base. I've just tried to emphasize that. If the carrying amount is greater, if the carrying amount is greater than the tax base, if the carrying amount is greater, carrying amount is greater than the tax base, you automatically inakwambia you are dealing with a taxable temporary difference. Taxable temporary difference. So always angalia. Ukiangalia how you've been given, what you've been given is carrying amount or net book value greater than the tax base. Automatically that amount that you have there, is your taxable temporal difference. So if you want now to get the deferred tax for that, just take the TTD given times the tax rate. That is under what? If you want to understand the TTD. Sasa, ukitaka kujua hii ingine ya deductible, unaona hii ni temporary. Deductible temporal difference ni vice versa. Vice versa ya hii. The carrying amount will be less than the tax base. So it will be the deductible. And it will give rise to what? Deferred tax asset. So hii itakupatia deferred tax liability. Kindly put a liability hapa. Liability. Yeah. So that you don't confuse. Yeah. This will give rise to deferred tax liability. And vice versa is true. Whereby if the carrying amount is less than the tax base, and all this utaambiwa, the examiner is very clear. The examiner will be very clear. You will be having a deductible temporal difference, which will give rise to the deferred tax what? A deferred tax asset. Basi tuko pamoja hapo. Are we together? Confirm kama tuko pamoja. Confirm kama tuko pamoja. Are we together? Are we together? Because this is important. This is just something that will help you to. So ukitaka kukumbuka pia ya asset, the deductible temporal difference, sema kwamba its carrying amount is less than the tax base. Ama vice versa, hata anaweza kuletea tax base is greater than what? The carrying amount, you know? You need to look at those terms. So deferred tax asset, how do we get deferred tax asset? Deferred tax assets and the deductible temporal difference. And the deductible. So let's have it. Deductible temporal difference. Deductible. And the deductible temporal difference. The carrying amount plus, is it greater than or less than the tax base? Carrying amount, is it less than or greater than? Less than the tax base. That automatically gives rise to the deductible temporal difference. The deductible temporal difference. So how do we get the deferred tax asset? Deferred tax asset from that. Deferred tax asset to be DTD. Yandika hiyo DTD, unajua tunamaanisha deductible DTD times tax rate. Andika hiyo times tax rate like that. Wrong sign using for DTD. Wrong sign. Oh, wrong sign. Yes, less than. Thank you, Flo. Great. I can see we are together. Yes. Exactly. Thank you. In fact, greater than, huwa tunaweka mkono ya right hivi, less than ni ya left. Yeah. Thank you so much. Thank you so much, Flo. Asante. Yeah. Thank you also hybrid and also given that. Yeah. Less than, left, greater than, right hand. Sawa. Yeah. Right hand. Sawa. Thank you. So ukitaka kupata hiyo deferred tax asset inapeanwa hivyo. So I think that is very okay. That is very okay. That is very okay. So class, there is or we calculate tax base. Tax base Tax base in most cases unapewa, eh? In most cases unapewa tax base, unapewa tax base, unapewa. Sasa nataka just like this is just a theory. In fact, this theory ilikuwa imeuliza definition ya temporal difference, deductible temporal difference, taxable temporal difference. What are those? You know. Now I just mention it here. May 2018. There is a question. May 2018. So this one hii mtaenda kuangalia. This one sasa ni hizo vitu tumepitia sahi. May 2018. Question number 1B. 1B. Kindly hizo theory enda uziangalie tena. Uziangalie tena. Hizo zenye tumeongelea. The taxable temporal difference, right? Taxable temporal difference. The deductible temporal difference, the current tax liability, actual paid by the company. So we have two approaches used in computing deferred tax. Approaches used in computing deferred tax. Deferred tax. Two approaches. The first approach is the balance sheet approach. Balance sheet approach. Na ingine ni income statement approach. Income statement approach. So kuna hizo approaches mbili used in calculating or computing this. So the balance sheet approach, just write this. Balance sheet approach. Deferred tax is computed using the temporary difference. The balance sheet approach. Balance sheet approach. Balance sheet approach. Deferred tax. Deferred tax is computed using temporal difference. Is computed using temporary difference. Temporal difference. Because that is a difference between the carrying amount and the tax liability. Current asset, difference between the current asset, difference between current asset, not carrying amount, current asset and current liability. Difference between the current asset and current liability of asset and liability. Difference between the current asset and current liability. That is it. For income statement, here ina mambo mengi pia. If you're using the income statement for the income statement, so under income statement approach, the income statement approach class, say that deferred tax is computed using the timing difference. Deferred tax is computed using the timing difference. Na unajua kwamba hiyo ndio mostly hiyo ndio inatumikaga. Here income statement mostly ndio inatumika. Deferred tax is computed using the timing difference. Using the timing difference. Deferred tax is computed using the timing difference. That is the difference between the taxable profit and the accounting profit. Difference between taxable profit and accounting. Ile yenye tuliona when you were starting, difference between taxable profit and accounting profits. In fact, we usually say that this is the recommended. According to IAS 12, this is Although any can be used, but you know, there is what is recommended. It is recommended. Any can be used, any method. So let's have the general knowledge that any can be used. Any can be used. Any can be used. Any can be used. Class. A question. Temporal taxable temporal difference or temporary difference give rise to taxable temporal difference give rise to taxable temporary difference give rise to taxable temporary difference give rise to deferred tax liability. Yes, deferred tax liability. Deferred tax liability, and in such case, the carrying amount is greater than the tax base. Carrying amount is greater than the tax base. And deductible temporal difference give rise to deferred tax assets. The carrying amount is less than the tax base. Hiyo ni kitu kishajua hivyo, mambo inakuwa sawa. Mambo inakuwa sawa. So there was a question that I want us to look at. And this was nataka tuone swali fulani pale. This question we had tulikuwa tumepitia, so nataka tuone tuka extract from this extract kidogo. Let's look at December 2021 question 5. December 2021 question 5. Of course, there's a Roman there I want us to check. Roman 4. Roman 4. Someone to share? December 2021, question number 5. Ile published financial statement. Published financial statement. Kuna ili hapo nataka sasa tuweze sasa kuelewa, you know, kuelewa why we did what we did. Under this. Ukiwa umeshika hizi, we will be able now to get it clear kabisa. Haya, tufike pale. Somebody akifika anaweza tuma screenshot kwa group. Can just share. December 2021, question number 5. Haya, tukifika tuone. Ala, some people did not. Okay. Bawabu, yes. That question. Hiyo ni swali tumefanya, but now I want you to understand why we did what we did during that time. Now after looking at this. So just take a screenshot and share with the rest. Share with the rest. Tuiangalie fasta. Taka tuchukue dakika kidogo, a very few minutes tumalizie, you know? I hope kila mtu amefika pale. There's a Roman there I want us to check. The estimated tax pale estimated tax pale tuko pale, kila mtu Evans asha watumia ala. Evans ametuma yote pale, watu wataweza ku Evans ungepiga screenshot utume kule kwa group. Ni sawa au kila mtu wako nayo sasa? Ala, watu bado si mtu mmoja atume tu bado kwa nini kwa group, kila mtu akue nayo. You take a screenshot and share. Screenshot is better. It saves time. It saves time. It saves time. It saves time. Note 3. Yes, Everin, you can just lead that part. Everin, acha tupe Everin chance hapa atusomee hiyo part. Hiyo ndio part nataka tuelewane. Everin ako wapi? Everin hapa. Yes, Everin Berita. Everin, just read for us that part. Tusomee your part. Your parts. Just unmute and read for us. Everin, you go to unmute. I think I've allowed you to unmute. Are you in a position to do that? Okay. Sawa. To save time, for me to just read. Maybe Everin is not in a position. Okay. Oh, we have Arnold. Let's just give Arnold to take part in that. Arnold, yeah, Arnold is here. Just a minute. Yeah, Arnold, you can just proceed. Arnold, check. Let's proceed.
So it's question 5, note number 3. It says Bawabu Limited estimated that an income tax provision of 113.8 million is required for the year ended 31st March 2021. The balance on the current tax in the trial balance represents the under/over provision of the tax liability for the year ended 31st March 2020. As at 31st March 2021, the tax base of Bawabu Limited's net asset was 292 million less than the carrying amounts. The income tax rate of Bawabu Limited is 30%.
Thank you so much. Thank you so much, Arnold, for that. Yeah, here we are. Good. Good. I hope now you're able to see items the way they've been given there. Now, in the trial balance, we have 12,800. Is it an over provision or under provision? Depending with now the knowledge that we have. Is it an over provision or under provision, class? Just check. Yeah. We have in the trial balance, when you check the trial balance, we have 12,800, of course, current tax. They're calling it current tax. Is it over or under? Automatically, is over provision. Over provision, right? I hope kila mtu anaiona over provision. So over provision, tulisema namna gani? How does it affect the next period tax? How does it affect the next period if it is over? Do we less in the next period tax or do we add? Do we less or do we add? It reduces the next period tax. And the provision for the period is 113.8. So allow me now to use the 113,800. So provision is equal to 113,800 less over provision. Over provision. which is 12,800. 12,800. Ukitoa tunabaki na ngapi? Ukitoa tunabaki na ngapi? That is now the tax to be charged in the income statement, in the current year income statement. Takuwa ngapi? Takuwa ngapi? Hiyo. Unatoa tu, hiyo ni a direct one. It's just a direct one. We offset the 12,800. Tunatoa 12,800. Tunatoa. How much? How much? How much? Let's get it very fast. I want us to just proceed. 101,000. 101,000. 101,000. 101,000. So that is now the tax to be charged. Tax to be charged in that period. That period. Then we have been given the tax base. Allow me to just remove this one. TB ni trial balance. So nikiandika TB ina confuse na tax base. This is trial balance. In the trial balance we had that. Now we've been given an amount here of 292. An amount here of 292. 292. 292. Now class. Will this amount help us to get the deferred tax liability or deferred tax assets? Will it give rise to deferred tax liability or deferred tax assets? Andika tu pale. Will it give rise to deferred tax liability or deferred tax assets? Kitu muhimu kwanza kupata. You see, they have told us that this one is less than the carrying amount. The carrying amount. The carrying amount. Less than the carrying amount. So this is a tax base is less than the carrying amount. Less than the carrying amount. Less than the carrying amount. So giving rise to, hiyo ni kumaanisha ni carrying amount is greater than. Naona walijaribu kuchanganya tax base. Carrying amount is greater than. It is true to say this. Naona, it is true to say that the tax base is less than the carrying amount. It's also true to say that the carrying amount is greater than the tax base, and therefore it will give rise to deferred tax. No, in fact, it's a taxable TTB, taxable temporary difference. Are we together? Taxable temporary difference, giving a deferred tax liability. Deferred tax liability. Is that correct? Is that correct, class? Tapatia deferred tax liability. Is that correct? Deferred tax liability. Taxable temporal difference. Taxable. It's not deductible temporal difference, it's taxable temporal difference. So from that, why can't we get the deferred tax liability given by T taxable temporal difference times the tax rate? Tax rate ni ngapi? 30%. 292,000 times 30%. Itakuwa ngapi? What will be our deferred tax liability? Deferred tax liability. Kwa ngapi? Deferred tax liability. How much will that be? Deferred tax liability itakuwa ngapi? Deferred tax liability. How much? 87,600. This is the balance that will be carried down. Balance carried down. So hapo ndio tukasema we come up with a tax account. Tax account. This is a credit debit. So what was the balance brought down? As far as this is concerned, balance carried out tuko nayo. Balance brought down ilikuwa ngapi? Balance brought down class in regard to the tax, deferred tax. Unaangalia tu pale kwa trial balance. Balance brought down kwa trial balance ni ngapi? Angalia tu kule juu kwa trial balance. Trial balance. How much? How much was the balance? Deferred tax. Unaangalia trial balance, deferred tax walikuwa wameleta ngapi? 97,600. And we have carried out. We don't have any other item affecting us there. 97,600, 97,600. So to corner deferred tax income of 10,000. Deferred tax income of 10,000. If the balance was on this side, it would be a deferred tax expense. So deferred tax income, income. What do you think will happen to this income? The tax for that specific year, the tax that was the current tax that was supposed to be paid, itapungua na hii income sasa. This is like an income now to the company. So tax itapungua. Tax itapungua. So what will happen? What will happen to our 10? It will be like added. When you add, so kuna 101,000. Hii ndio sasa hii inapungua. So unapunguza 10,000. Unapata 91,000. So the tax payable in that specific year is 91,000. If you maybe go back and check, that could be the tax that we recorded. True or false? True or false? True or false? Hiyo si ndio tax tulirecord. Hiyo si ndio tax tulirecord. Ukiangalia swali kwenye tulifanyia swali, hiyo ndio tax tulirecord, right? Yes. So that's how. In fact, mtu mwingine atakuja kuambia hapa weka hizi ni negative, alafu hapa ongeza. So itakuwa tu the same, ili ubaki na tax yako ikiwa in negative form, you less, showing that you less. Sasa I hope that is clear. I hope that is clear to all of us. I hope that is clear. You know, when we were doing that, I did not want to bring in much of this. I did not want to bring in much of this because your time ingekuwa noma kuleta hizo. Are we now together? Are we together? Want us to do another question? Are we together? Just confirm that whether we are together. Just confirm. Want us to look at another question? But I can give you 3 minutes za kufikiria as you look at April 2023, question 5. April 2023, question number 5. So as you look at that question, pata dakika 3 za kupumzika. April 2023, question number 5. April 2023, question number 5. April 2023, question number 5. So somebody can be sharing this. 2023, question 5. So tunaweza tuma hiyo swali dakika 3 alafu tuendelee. 3, then we proceed. So team, let's proceed. There is a question that have been shared. April 2023, question number 5, are still helping us to understand more about the deferred tax. So the question reads, it is 5 B for boy. 5B for boy. 𝐷𝐸𝐴𝐳 Manufacturers Limited, a small firm engaged in the production of fertilizer, purchased an item of equipment for 12 million on 1st of July 2018. The company provides depreciation on equipment on a straight line basis at the rate of 25% per annum, right? During the 4 years, from 1st July 2018 to 30th June 2022, the profit after tax allowed wear and tear charges for the tax purposes were as follows. So you've been given the period 1st of July 2018 to that of June 2019, all the way to 1st of July 2021 to 30th of June 2022. And the profit after tax and allowable wear and tear charges. Then Corporation tax for the period for the 4 years of the 4 years remain to be 30%. Compute for each of the year ended, that is June 2019, 2020, 2021, 2022, the taxable profit and deferred tax. The taxable profit and deferred tax. Taxable profit and deferred tax. So profit after tax, I think that should be profit before tax here. Profit before tax. These people waache mchezo. Profit before tax. Because when we talk of profit after tax, we usually talk of profit before tax. So if you have a hard copy, you can correct that one. Profit before tax. B. Now class, solving the question. This BXL manufacturing. The position wamesema tumie straight line. How do we compute the taxable profit? How do we compute the taxable profit, class? Taxable profit. Can have taxable profit here. Taxable profit. Taxable profit can be given by profit before tax or accounting profit plus any allowable or disallowable expense plus disallowable expenses minus usually that what allowable expenses, which is the same as wear and tear in tax. Allowable expenses they are not part of, they are not taxed. Allowable expenses are not taxed. Wale watu wa tax allowable expenses ni kama gani tofauti? The example ya allowable expense ni kama gani? Allowable expense ni kama gani? In this case tumepewa ndizo the wear and tear. This is a depreciation. It's disallowable expense. You know? Yeah. NSSF. The pension, Pension. Sasa, in this case, we have 4 years. So solution to this, tunaweza anza na miaka yetu. Tuko na that is June 2019. That is of June 2019. Tuko na that is of June 2020. That is of June 2020. Tuko na ya tatu, that is June 2021. Na ya mwisho, that is June 2022. That is of June 2022. And our shillings ziko in 1,000. Shillings are in 1,000. Hapa. Shillings are in 1,000, like that. Mashilingi zetu, or we have truncated 3 zeros. We have truncated 3 zeros. So what is the profit before tax? Profit before tax yetu ziko pale. Profit before tax. Tuweke akila mwaka 2,400, 2,700. This is just a matter of checking what we have. 2,850. Niko na 2,550. So somebody alicomputed depreciation. I remember depreciation we cut across. Depreciation itacut across. Itakuwa to the same. So somebody to compute for us depreciation ni ngapi? So tumia straight line. Straight line is, or you can use the rate. The rate is 25% of the. Haya tupatie depreciation. Edna anapatia 3,000. Edna has appreciated the fact that tumepatiwa depreciation rate as 25% and the cost of the original cost is 12 million. So, 12 million. Original cost is 12 million. So lazima tuangalie hiyo. So the fertilizer purchased an item of equipment for 12 million, and depreciation rate is what? Is 12 million. So add depreciation. 3,000 all through. 3,000 all through. Now class, after that, we can less wear and tear. Wear and tear. Wear and tear tumepewa pale na ziko pale vizuri 48, 36, 24. 48, 36, 24, 12. So nataka tupate our taxable profit. Remember hii taxable profit itasaidia sana uko mbele. Taxable profit. Tupate taxable profit class ya mwaka wa kwanza, wa pili, wa tatu, wa nne tukimaliza. Haya, ya kwanza ni ngapi? Taxable profit. Ya kwanza. Just compute from your end. Ya kwanza. Ya kwanza. Taxable profit ndio mimi nataka pale. Tukishapata hiyo, mambo inakuwa smooth. Please adjust on the margin ya 2022. Yeah. I hope iko clear somewhere. Iko clear sasa. Patia mwaka ya kwanza pale. 24 plus this minus this. Hivyo tu. 600. Tutapata 600. Kwanza tunapewa 600. 600. So kwanza tuko na 600 hapa. Ya pili, ya tatu, ya nne tumalize. Nataka tumalizie hii kama itawezekana. Itakuwa sawa. Where do we get the values of tax, please? Tax. Mtu ameuliza swali nzuri pale. Which tax? Which tax? Which tax? Which tax? Hapa hatuna tax yoyote kwanza. Bado. Ya pili, ya tatu. Ya tatu ni ngapi? Ya tatu. Ya tatu. Alafu ya nne. Hybrid ni tax gani unauliza sasa? Wear and tear. This is wear and tear, eh? Wear and tear. And we usually call them allowable expenses. 3450. 3450. Na mwisho. Let's get the last one. Let's get the last one. $43.50. Ya mwisho ni $43.50. $43.50. I hope kila mtu anapata hivyo. And that is our taxable what? Our taxable $43.50. That is our taxable what? Taxable profit. Taxable profit. Taxable profit. Yes, the wear and tear. Wear and tear. Wear and tear. Wear and tear. Hybrid atuliza. Wear and tear tumetoa wapi? Wear and tear tumetoa wapi? We just take the rates, eh? You just take the rates, 40% on cost, and cost is 12 million. Sawa. Yeah. Good. Let's now go to the next part. The next part. How do we get the current tax? How do we get the current tax? Current tax will be given by taxable profit times the tax rate. Taxable profit times the tax rate. So taxable profit tuko nayo ya kila mwaka. Na tax rate is how much? What is our tax rate? Class? 30%. So 30%. So I'll be having 2019, 2020, 2021, 2022. 2022. Our shillings are in thousands. So current tax for each. What is 30% of 600? Remember, sasa hii ndio tunaleta hapa. 30% of each. 600 nakuwa 180. Haya, hii ingine 21. 30% of 21. 30% of 21 tukisonga, tukatumalizie 2100. That is. Mnapata ngapi? 30% 21. 630. Hiyo ya 3450 3450, 3450, 3450. 30% of 3450 na 45, 4330. 450. 30% of 1035, 1035. Na mwisho 1035. The last one, 1305. So as far as that is concerned, hivyo ndivyo ulitakiwa upate nini? Upate your taxable profit. Alafu at least we've been able to get the current tax. Now we can move to getting the deferred tax. Deferred tax for this. Deferred tax, it always arises due to the difference between the accounting profit and the taxable profit. Arises deferred tax is equal to or arises due to the difference between accounting profit and taxable profit. Accounting profit and taxable profit. Accounting profit and taxable profit. Now, for instance, if we look at year 2019, plus 2019, how much profit was this company supposed to pay as far as the accounting profit is concerned in year 2019? In 2019, the company was supposed to pay how much? 30% of the profit before tax, right? Of 2400. Ilikuwa inafaa ilipe ngapi? How much was the company supposed to pay? Let me to just adjust. Ilikuwa inafaa as far as accounting profit is concerned, ilikuwa inafaa ilipe 30% of the profit before tax, 30% of the profit before tax, which would be 720. So how do we get deferred tax for that year? Deferred tax for that year is equal to 720 minus the 600. Si ndio? Taxable profit si tuko nayo pale. Taxable profit ni ngapi? The actual tax yenye ililipa, the actual tax yenye ililipa ni hii, the current tax. This is like the actual tax. Actual tax yenye ililipa. Actual tax. So, if you less the actual tax coming from the taxable profit, right? Coming from the taxable profit, of course, 30% of the taxable. What is the difference? 540. So in the year 2019, deferred tax will be 540. Deferred tax will be 540. What about in year 2020? Deferred tax itakuwa ngapi? Deferred tax, hiyo ndio tunatafuta. So in year 2019, deferred tax 2020, it will be deferred tax will be 30% of the profit before tax, which was 2700 minus 630. Ngapi? 90. Tunapata 90. 180. Ala 30% of 2700 minus 630, 180. So hapo tuko na 180. 2021 deferred tax will be 30%. This is accounting profit times 2850 accounting profit minus the actual tax paid, 1035. Itakuwa ngapi in that year? Itakuwa ngapi in that year? 180. Hapa tunapewa pia 180, which is a negative like that. So tutaona ni gani income na ni gani expense. Haya. Then 2022 deferred tax 30% of 2550 minus 1305. Haya, itakuwa ngapi? Itakuwa ngapi hiyo? Itakuwa ngapi? Hiyo ya mwisho sasa. Ya mwisho 540, which is a negative 540. Class 1 to year 2019-2020. Is this giving rise to deferred tax income or deferred tax expense? Hizi zenye ziko na positive. Does it indicate deferred tax income or deferred tax expense? Hizo za kwanza. Income expense. Expense. Yeah. This one give rise to deferred tax expense. Deferred tax expense. You know? Deferred tax expense. And automatically hizi zingine deferred tax income. Deferred tax income. Deferred tax income. You know, these are tax. Unajua, hii ni liability. So liability, the treatment of liability is different from the treatment of asset. The treatment of asset. So in the year 2019-2020, we had the deferred tax expense, and 2021-2022 deferred tax income. Deferred tax income. Deferred tax income. And that is how you are supposed to do that. That's how you are supposed to do that. That's how you are supposed to do that question. That's how you are supposed to approach that question. That's how you are supposed to approach that question. That's question. So class, hapo imebaki tu revision hapa na pale kidogo. Hapo kwa mambo na income tax, revision ndio imebaki kidogo. We shall be able to see. But if you come across a question, please try to do. If you come across the question, please try, attempt to do any question that you come across. Just attempt. Next time we meet, which is on Thursday, we shall look at farm accounting. So kitu ningetaka uende uangalie ni IAS 41. It talks about farm accounting. How do farmers prepare their what? Their income statement. All right. Ivans amesema, yeah, it's okay. Pole to keep on trying and doing them more and more. At this moment, your division book you should be now picking the second one. Unaandika vitu zako. Unaandika vitu zako, unafaa unachukua ya pili sahi sasa. Hiyo yenye unaenda nayo hadi ufanye mtihani. You revise kabisa, unafanya hizi vitu. Sometimes you repeat them, you repeat what we have done without looking at how we did it, and then you can confirm from what we did. That's how you get to understand these things. And as you do them as many times as possible, you get to master and know them. So farm accounting, IAS 41. So kindly during your free time, you can Google the IAS 41, just see what it says. Alafu sasa on Thursday tutaweza kufanya nini? So as far as this is concerned, it will be the second last computation. Kuna branch accounting, it was there in August. So maybe if time allows, we shall look at the concept of branch accounting. Walileta August. So high probability za kurudia hiyo inaweza kuwa chini. Probability za kurudia hiyo inaweza kuwa chini, but hatutapatia anything a chance. We shall look at its basics, the basics of branch accounting. But as far as the computation is concerned, it is this topic and borrowing cost. Borrowing cost and this topic. Borrowing cost, a concept and a borrowing cost. Interest. Talking about, borrowing cost is the same as interest paid to the loan borrowed. So accounting, farm accounting, your next. Alafu hiyo ingine tutaangalia baadaye. So as far as that is concerned, asanteni sana for having time to attend our today's session. May you all have a blessed day. So come ready for farm accounting, the next class. Goodbye.